Welcome to this tutorial. We're going to be looking at government grants. We have an example with us here, and we are going to get right on it. Nebula Limited entered into an agreement on 1 May 2007 to buy 3 mobile clinics for $5 million in total to be used in rural area in Mpumalanga. On 2 January 2008, the clinics were received and ready for use. The risks and rewards of ownership were transferred to Nebula Limited, and the building contractor was paid in cash. Since it is important for national government to provide medical services to all citizens, Nebula Limited received a government grant of 625,000 asset-based on 2 January 2008 in respect of this clinic. Nebula Limited provided medical services from 2 January 2008 and had to employ 3 general practitioners and 3 qualified nurses from that date. To encourage Nebula Limited to continue with the provision of medical services, the provincial government indicated that it would subsidize the salaries of medical staff provided that it would appoint them. Nebula Limited had to contract the medical staff for a period of 3 years, whereafter the provincial government would appoint new medical staff or renew the contracts of the current staff. The total government grant amounted to 2.1 million for the 3 years received in year 1. If any of the conditions are not met, the total or part pro rata for the subsidy will have to be repaid. The annual salaries amounted to 400,000 per general practitioner and 200,000 per nurse for the year ended 31 December 2008. It was expected that the salaries would increase by 8% per annum. The clinics have a useful life of 10 years. It is the government's policy to depreciate the clinics over the useful life of on the straight line method. Additional information: the government grants are taxable. The South African Revenue Services will grant a tax allowance on a pro rata basis of 5 years on the straight line method on the total cost of the clinics. Nebula Limited's profit before tax but after grants and related depreciation were taken into account amounted to 1.355 million for the year ended 31 December 2009 and 1.450 million for the year ended 31 December 2009. The company provides for deferred tax on all temporary differences by using the statement of financial position approach. The only temporary difference are those in respect of the grants received. The balance of the deferred tax account on 1 January 2000 was nil. Assume an asset normal tax rate of 28%. It is estimated that the company will realize taxable income in the future. Okay. And the question, we've got 2 questions, but in this tutorial we're going to limit ourselves to the first one. So required: prepare the general entries and calculate the figures to be included in the statement of profit and loss and statement of financial position for the year ended 2008 and 2009, assuming the income-based grant is deducted in reporting the relevant expense, and the asset-based grant is considered to be deferred income. Okay, right. So the first thing we have to do is to note what type of grant we have. So in this example we are given 2 grants. One of the grant is asset-based, and one of the grants is income-based. So those are the 2 situations we have, and that's the first task for you to recognize what you're given. So the asset-based grant, we classify it as asset-based because 1, they've specifically said that it's asset-based in the question. And we can see from the definition of an asset-based grant, it is a grant that is forwarded for the acquisition, purchase, or erection of a non-current asset. This grant has been granted for the purpose of building clinics a clinic. Therefore, it is an asset-based grant because they are going to create a non-current asset. Right. So the grant is an asset-based grant. That's the first thing to note. The second thing, the question specifically states that the asset-based grant okay, so assuming the income-based grant is deducted in reporting the relevant expense and the asset-based grant is considered to be deferred income. So on the asset-based grant, we are told that it's considered to be deferred income. Okay, so this shifts the way we're going to treat the asset-based grant because there are two ways of treating an asset-based grant. You can either treat it as deferred income or it will be deducted from the cost of the asset to arrive at the new asset price. But in this case, they said treat the grant as an deferred income is to be considered as deferred income. So that's exactly what we're going to do. So what we need to take note here is how we treat a grant which is considered to be deferred income. Now the first thing we note there is that the full amount of the grant is taxed in year received. Right. And deferred tax deferred tax implications will arise in respect of deferred income. And we should know that the tax base of the grant will be new, and since the tax base of the grant will be new, it also implies that the carrying amount of the grant will be greater than the tax base, resulting in a deferred tax asset. Okay, so that's how we're going to treat our deferred tax asset there. They said it should be considered to be deferred income. Right. Now we got an income-based grant, and according to the question, they said that assuming that income-based grant is deducted in reporting the relevant expense. Now, in our case, the income-based grant is there to subsidize the salaries of the nursing staff, the hospital staff. So we got our general practitioners, and we got our nurses. Yeah, we got our nurses and our general practitioners, and these salaries are expected to increase at 8% per annum. But we received a government grant in respect of that to the tune of 2 million, and that government grant is expected to be recognized, to be deducted from the relevant expense. That's what they said. So if the grant is to be deducted from relevant expense, right? So the grant is going to be deducted from the relevant expense, and then we should take note that the full amount for current tax purposes, the full amount is taxed in year received. And then for deferred tax purposes, for deferred tax purposes, we treat it the same as asset-based grant recognized as deferred income. So treat as asset-based grant recognized as deferred income. In other words, we are just going to follow this treatment for deferred tax purposes. This treatment is the same treatment we are going to apply to our income-based grant. Now, let's crunch the figures. Okay, before we crunch the figures, we are going to have a sequence of events. So this is how we're going to do it. The first thing, so I'm going to detail our steps. We're going to do is to calculate the salaries paid and grant recognized. The second thing is to calculate the balances of the deferred government grant. The third thing, the third step is to clearly show the income from government grant deducted from expense. The fourth item will be to calculate your deferred tax. The fifth item will be to calculate your current tax. And then you do your journals, and then the last thing will be your disclosure. So this is basically the sequence of events that we're going to follow in recording this grant. Yes, of course, the question states that we have to prepare the general entries, but the general entries, some of the figures that we are going to use for our general entries will need to be calculated first. Hence, we have to do these calculations first before we do our general entries. And then the last thing that we'll have to do is to disclose our figures. Okay, so we're going to do the first step now to calculate the salaries paid and grants recognized. Right, so for this we are going to start with our salaries, and they say the annual salaries amounted to 400,000 per general worker. They amounted to 400,000 per general worker and 200,000 per nurse for the year ended 31 December 2008. It was expected that these salaries will increase by 8%. Right. We also need to know how many general workers we had. So we had 3 general workers, general practitioners, and 3 qualified nurses. So we had 3 general practitioners, these are doctors, and 3 qualified nurses. The general practitioners were earning 400,000 and the nurses were earning 200,000. So here we're going to have salaries and then in 2008 we had 3 general practitioners, each earning 400,000. We also had 3 nurses, each earning 200,000. to give us a total of 1,800, 1.8 million to be specific. In 2009, nothing really changed, so we are going to still pay these people their 1.8 million, but we are told that their salaries are going to increase by 8% each year. Therefore, you multiply the salary for 2008 by 1.08 to get 1.944, like that. In 2010, this salary again is going to increase by 0.8 by 8%, so you multiply it by 1.08, and then you get 2,099,520. If you add the total of these figures, you're going to get 5,843,520. Okay, so those are your salaries. Now the next thing you have to calculate is how the grant will be recognized. So the grant will be recognized as follows. Right. So we know that the total grant which was given amounts to 2.1 million. So take note, total grant is 2.1 million, as given in the question, in the information about the question. Where is it? So here we're talking about the income-based grant. So the total income-based grant for the 3 years amounted to 2.1 and it was received in full in year 1, but each year they will have to recognize a particular portion of that 2.1 million. Right, and that portion is in relation to the salary in that period. So it's more like we're sharing the grant pro rata here. So in 2008, the salary was 1.8 million. Over a total of salaries of 5.843,520 for all the 3 years for which the grant was going to be valid. So we multiply that by the grant amount of 2.1 million. Therefore, in year 1, on this pro rata basis, only 646,870 will be recognized. In 2009, salaries which were paid in 2009 amounted to 1.944 thousand over the total of 5,843,520. So the total of salaries is this, and the salary for 2009 is that one. So check it there. Times the full amount of the grant, which is 2.1 million, and that is going to give us 698,620. And then in 2010, in 2010, 2,099,520 was paid in salaries out of a total of 5,843,000 of the salaries for the 3 years. So 2,099,520 over 5,843,520 multiplied by 2.1 million will give you 754,510. Right. If you add all these figures, they should give you 2.1 million, the full amount of the grant. So this procedure of recognizing the grant will apply for all income-based grants, whether it is deducted from the related expense or recognized as a separate line item in the statement of profit and loss. We will have to recognize the grant in this way. Right. We could straight away show the income from so number 3. So we said the first one, salaries paid and grant recognized, we have calculated that. Number 2 is deferred government grant, and number 3, income from government grant deducted from expense. We can show number 3 right away, which is the income from government grant. So on our stages there, instead of going to number 2, I've gone to number 3. Take note. I'll come back to number 2 just now. So income from government grant deducted from expense. So in 2008, we had 1.8 million of salaries to pay, and the grant that is recognized in that period is 646,870, and then we are subtracting that from the relevant expense. So this is income from grant deducted from relevant expense. Okay, so we are recognizing that our expenses of 1.8 million in terms of salaries in 2008, and the amount of grant that is recognized in that period is 646,870, and then we subtract it from our grant. Therefore our expense in terms of salaries is going to be reflected as 1,153,130 in our profit and loss statement. In 2009, our salaries amounted to 1,944,000, and the grant that was recognized for that period is 698,620. Therefore, in our profit and loss statement, we are going to show 1,245,380. Right. So that is the figure that we're going to show in our profit and loss statement. Okay, so these are the figures that we're going to take to our profit and loss statement as expenses relating to loans. Take note, our expenses have been greatly reduced by the grant. Okay, so let's go to step number 2, and then all the other steps will follow. So step number 2, we're going to calculate the deferred government grant. Alright, so for us to calculate this, we'll have our opening balance here, then accounted for during 2008, and then we'll have, let me underline this so that it won't distract us, and then we'll have closing balance, (2008), and then we have accounted for (2009), and then closing balance, uh, 2009. Right, and then we have two types of grants. The first one is income based, and the other one is asset based. Right, and then from our reading we note that our asset based grant is 2.1 million, our income based grant, sorry, and our asset based grant, we noted that it's, let's just check again. Oh yeah, where is it? Here, asset based grant is 625,000. So 625,000 is our grant. Now Let's just take a look at how we are supposed to account for our asset-based grant. Since it is important for national government to provide for medical services to all citizens, Nebula Limited received a government grant of 625,000 asset based on 2 January 2008 in respect of the clinics. The government grant are taxable. The South African Revenue Service will grant tax allowances on pro-rata basis for 5 years, over 5 years on a straight line basis. Alright? Okay, and then what else? The company provides for deferred tax on all temporary differences using statement of financial position and press. The only temporary difference are those in respect of government grants received. The balance of the deferred tax account was nil. Okay, all that is fine. The clinics has a useful life. Now, this is what I've been looking for all this time long. So they say it here. The clinics has a useful life of 10 years. It is the company's policy to depreciate clinics over the useful life over the straight line method. Okay. So the clinics has useful life of 10 years. Therefore, our asset-based grant is going to be, like we said, it is recognized over the useful life of the asset. It is considered to be deferred income over the useful life of the asset. Therefore, since our clinics are going to be in use for 10 years, our grant, which is of 625,000, will also be spread over the useful life of the asset, which is 10 years. Therefore, each year we're going to subtract 62,500. We are going to recognize 62,500 in respect of our assets. Alright. Now, on our income-based grant, we calculated that in 2008 we recognized 646,870. Right, so that's what we're going to have here. Accounted for in 2008, 646,870. And then for asset based, each year we are going to recognize 62,500. So these amounts are going to be subtracted from the carrying amounts of the grants. So to get a closing balance, which is 2.1 million minus 646 here, it will amount to 1,453,130, and here it will amount to 562,500, and the total of the grant recognized this year will amount to the total of these two, which is 709,370. And here our closing balance of our grants, the total of them at the end of 2008 will be 2,015,630. Right. In 2009, for our income-based grant, we recognized 698,620, So for income-based grant, we have 698,620, and for our asset-based grant, it will still be 62,500. It doesn't change from year to year, this one. Right. So the total amount of grants recognized in 2009 will be 761,120, and the closing balance for income-based grant, which is the closing balance of 2008 minus the portion of the grant recognized in that year of 2009, so it will be 754,510. And then here 562,500 minus 62,500 will give us a closing balance of 500,000, to give us a total of 1,254,510. Okay. Right, so that's for our deferred government grants. Okay, so with that in mind, we go to the next. So we have our important figures for that. That's the closing balance. For our grants for 2008, we'll use these figures in our disclosure and the statement of financial position, and then the closing balance for our grants there, and then these amounts accounted for during the year are going to be important again for our income tax purposes. Right, now we go to the next stage, calculation of deferred taxation. Deferred taxation. So we are going to have our carrying amount, our tax base, temporary difference, and then deferred tax at 28%. Right, so for 2008, we've got our asset and then our deferred grant. Alright, so at the end of 2008, okay, let's take note that our clinics were valued at 5 million. But at the end of 2008, they had a carrying amount, since they are going to be depreciated over. Okay, so we said 5 million. This is okay, 5 million, so I'm going to erase those zeros. And then they said depreciation is going to be over 10 years, so our depreciation there, so let's just write depreciation per annum is going to be 500,000. Therefore, the carrying value at the end of 2008 for our assets will be 4.5 million. That is, our cost of 5 million minus depreciation gives us a carrying value of 4.5 million. So we can say 5 million minus 0.5 million. It will give us 4.5 million. Right. So our carrying value for our clinics is 4.5 million. And then the carrying value of our deferred grant, that is the portion of the grant which is not yet recognized for is this amount. The closing balance for 2008 was 2,015,630. Right. Okay. And for our grant, we said since it was taxed in the year in which, since it is taxed in the year in which it is received, the tax base will be nil. And then the tax base for our asset is going to be, right, okay, let's go back to the question a little bit here. Now, take note here. The government grants are taxable. The South African Revenue Service will grant tax allowances on a pro rata basis over 5 years. Right. So take note, on a straight line method on the total cost of the clinics. So take note of that. So the tax allowance on the clinics is going to be the cost, which is 5 million over 5 years, and this is going to give us 1 million. Right. Therefore, the tax base at the end of 2008 will be 5 million minus the tax allowance, which is 1 million, to give us 4 million. So for the asset there, the clinics, they're going to have a tax base of 4 million resulting in a temporary difference of 500,000. And then if we tax that at 28%, we'll have a tax asset of 140,000. So this is a liability, tax liability of 140,000. And then here, since the tax base is 0, our temporary difference will be, so deferred tax grant, the deferred grant will be there, and then temporary difference will be 215,630. And if we tax that at 28%, we'll have 564,376 deferred tax asset. Now if you're adding these two, you'll then get 424,376. which is an asset because this one is bigger than the asset is bigger than the liability there, so it will be an asset. Again, if you are adding these two, you get an asset of 1,515,620. Here the tax base will be 4 million. This one is positive, it's an asset, it's a liability, and here the total of the carrying amounts will be 2,484,370. Right. In 2009, we still have our asset and deferred grant. Now, the depreciation for our asset is 500,000. The annum is calculated. So the carrying amount of our asset will have decreased because it's another year now, from 4.5 million to 4 million. And then our deferred grant would also have decreased so in 2008, for our deferred grant, we had to take this amount, the closing balance, which is this one, and in 2009 we will take this closing balance for our deferred grant. So we had already calculated that, so it will be 1,254,000. Okay, I have to change my pen there. 1,254,510. The tax base for our deferred grant is 0, and here, since it's over 5 years, we've calculated our tax allowance to be 1 million a year. So it was 4 million in 2008, it will be 3 million in 2009. So our temporary difference there will be 1 million. And our deferred grant temporary difference will be 1.254510 there, because the tax base of a deferred grant is 0. Okay, resulting in taxation at 28%. So you're saying this 1 million times 28%, you get 280,000. And then this 1.245 million by 28%, you get 351,263. Okay, so the total for these two is going to be, so this one is a liability and this one is an asset. The total for these two is going to be 71,263. and then these two, 254, 510, and this one it will be 3 million, and here it will be 2.745 490. Right. So basically, these are our deferred tax implications, and we are left with representing them in this statement of financial position. So take note of the important things there. That is how we calculated our deferred tax. For our asset, our temporary difference are just resulting, like we said, our deferred tax will result as due to the differences in terms of the rates used to calculate our capital allowances and depreciation. That's why here we're 4.5 million and 4 million, and that will result in deferred tax. That's the reason for deferred tax differences for an asset-based grant. And for an income-based grant, deferred tax is based on the outstanding amount that has not yet been recognized in the period, and in our case is 2,015,630 for 2008, and in 2009 it will be 1.254,510,000, and that amount you get it from the deferred government grant as calculated above. Now we have to calculate our current tax. Right. If everything has been done correctly, this will be it will be easier at this stage. Okay, so we are going to have our accounting profit for the years. So we have 2009 and 2008. Then our accounting profit for 2009 and 2008, we are given another number 2 Nebula Limited profit and before tax, but after the government grants and related depreciation was taken into account, amounted to 1.355 for the year ended 2009 and 1.450 for the year ended 2008. Therefore, we are going to recognize that here, so that we calculate our current tax. So in 2009 it's 1.355,000, 1.450 in 2008. Now we have to calculate our temporary differences. Right, and how do we get to the figures there? So we have depreciation. Remember that depreciation is added back when we are calculating tax. Now our depreciation, we calculated it and we found that the depreciation was 500,000 each year. So we add back depreciation, and then we take off the tax allowance. On clinics, tax allowance is deductible. So the tax allowance was the value of the clinics was 5 million over 5 years. The tax allowance was 1 million per annum. So we subtract the tax allowance, and then government grant received. Okay, so in respect of the salaries, we received a grant of 2.1 million plus 625,000 for the construction of the clinics, to make a total of 2.7 million 225,000. Remember, we said the grant is taxed in the year in which it is received, so we add that to our profit figures, because the full amount of the grant, whether it is asset-based or income-based, it is taxed in full in the year in which it was received. So we have to add the full amount of the grant there. And then government grant, income recognized. Right. So the income recognized in a particular period is subtracted. So we recognized this amount, 646,870 for 2008 and 698,620 for 2009. We need to deduct those amounts. So for 2008, okay, let me just double check the figures again. Alright, okay, the full amount that is deducted, so this 646,870 and 698,620 were only in respect of income grants, but the full amount of grants recognized in 2008 was 709,370. That is the total of the income-based grant and the asset-based grant. So to that 646,870, you add the portion for asset-based grant to give you 709,370 for 2009, for 2008, and 761,120 for 2009. So that's the total of the incomes recognized in respect of our grants. So for 2008, we recognized 761,120. So we deduct that, and in 2008 we had recognized 709,370. We deduct that. So all these amounts if we total them up, here we're going to get our temporary differences of 1.2 million, 1.2 1.261 million, 120 negative, and here they will be positive by 1,515,630. And then if we take our accounting profits and subtract these figures, we get our taxable income of 93,880 here and 2,965,630 here. And then current tax, at 28%. Will give us 26,000 for this year, 286, and 830,376 here. So these are our current tax for the year. Right. Now we can do our journal entries, and then after that we do our disclosure. So we are going to have journal entries, for the year ended December 2008 to 31 December 2009. Right. So on 2 January, that's when we received the amount for, that's when we started building our clinics. So this is debit, and then here we have credit. These are rents, our currency here in South Africa. So we erected clinics, so that's property, plant and equipment. We're going to debit clinics to the tune of 5 million. Okay, pardon my eyesight there. So we're going to have PPE here, and then this month was coming from our bank account, so our bank account loses 5 million there, and our assets gains 5 million. But our bank immediately gained, so bank, it gained the amount of government grant which was given to us by the government. So here we have government grant, 625. Right. The bank also received so this is let's call it deferred government grant, and this is in the statement of financial position. The bank also received 2.1 million in respect of the income grant. So deferred government grant here are the income based, 2.1 million. So the bank benefits and we credit the deferred government grant like that. That is what happened on 2 January 2008. Right. Now, at 31 December 2008, that is the end of the year now, we had depreciation of 5 million over 10 years. So depreciation is debited by 500,000 for our assets. We had clinics of 5 million, so depreciation on those clinics, and then accumulated depreciation gets credited by 5 million here. Now, deferred government grant. Now the grant is now getting reduced as we recognize the grant through the profit and loss. So 625,000 over 10, because this is the asset-based grant of 625,000, and we said it's going to be recognized over the useful life of the asset, which is 10 years. So the grant here is going to be reduced by the balance in the statement of financial position is going to be reduced by 62,500 in year 1. And then this is in the statement of financial position where we are reducing this amount here is going to be reduced. Okay, I marked the wrong one. This amount is going to be reduced by 62,500 as we write it through to the profit and loss statement. So we're going to write deferred government grant received, and this is statement of profit and loss. Alright, and then we put our 62,500. Same applies for our income-based grant. We calculated that the income-based grant will be written off in this fashion. So in 2008 we recognized 646,870, and in 2009 we recognized 698,620 for our income-based grant. So in 2008 the grant will be recognized as follows: 646,870 in 2008, the income-based grant. So for the income-based grant, in the statement of financial position, we are taking off 646, 870. And then our employee benefits are going to be reduced by that same amount. Remember, it's an income-based grant, and they say that it should be it should reduce the relevant expense. That's one of the conditions on the question. So that's the general entry is the 31 December 2008, and at 31 December 2009. So these are our journals at 31 December 2008. At 31 December 2009, we'll have our depreciation of 500,000 on our clinics, which are valued at 5 million, and then our accumulated depreciation will also be 500,000, so we credit it with 500,000 like that. Deferred government grant, our deferred government grant, in the statement of financial position, on this one I'm just going to write asset. Same applies here. I'll just write asset so that we know that we're taking off from the asset, that is our clinics. We are going to reduce it by 62,500, and then we write government grant received. So we are writing off it in the statement of profit and loss, 62,500, and then the income-based grant. So deferred government grant in the statement of financial position, we said in 2009 we recognized 698,620 for the income-based grant. So in 2009 we are taking 698 620, and then our employee benefits for that year will be reduced by that same amount. Right. Now, so these are our general entries recognizing our government grants. The last thing that we're going to talk about now is disclosure. So we're just going to have a disclosure extract of the important figures here. So we have figures to be included, and the statement of financial position. So we have 2009, and then it's in rands. 2008 is in rands again. So under property, plant and equipment, you have mobile clinics, so carrying amount at the end of the period, and we have cost and accumulated depreciation. Right. So the cost of our mobile clinics was 5 million in both years. The cost is not changing. 5 million in this case. Remember, our grant is not deducted from the cost of the asset, but rather is treated through other comprehensive income. But our depreciation was over 10 years, so each year is 500,000. But now this is accumulated depreciation, so for the 2008 in which we build the clinics, it will be 5 million, giving us carrying amount of 4.5 million. In 2009, depreciation will be 500,000 plus the 5 million from the previous year to make a total accumulated depreciation of 1 million. And then if we subtract that from the carrying value of the asset, we'll get 4 million. So we'll just put these values in a box. Yeah, that's the accounting way of doing it. Right. Now, you then have your deferred government grant. Right. So I'm just going to show you two ways of getting to these figures. The first way is to take the full amount of your grant, and then you subtract for 2008, for instance, full amount of your grant will be 2.1 million plus the 625,000, right, that you received. So that will be 2.725 million, and then from that amount in 2008 you're going to subtract the portion of the grant which was recognized in that year through the profit and loss, which is this 62.5 and this 646,000. So if you subtract those two amounts from 2.7 million, 2,725,000, if you subtract these two amounts, that is the portion which has recognized through profit and loss, 625,000, and the portion which was recognized through profit and loss for the income based, which is 646. If you subtract those two amounts, you will get 2,015,630. Another way is what we have already done, which is to just come and take the closing balance from your deferred grants table that you've already calculated here. So you take this balance, and for 2009 you will just take this balance, 1.254510. Another way of just getting this amount that you show on a government grant will be for you to say, okay, that will be too long now, but we are saying the balance of 2008 after subtracting these two amounts recognized in the period, these two, you come again from that same balance, you subtract the amount that were recognized for 2009. So your balance for 2008, so you're just saying your total grant, which is 2.750, minus the amount which was recognized in 2008 minus the amount which was then recognized in 2009. You get your closing balance for 2009, which is this amount. So basically this is how you account for your asset-based grant and your income-based grant if the figures to be included in the statement for the years 2009, assuming that the income-based grant is deducted in reporting the relevant expense and the asset-based grant is considered to be deferred income. Thank you for watching. Let's meet again in future videos.